Hello YouTube, welcome to part 1 of the algorithmic programming series that I decided to do. So in this series we're going to be doing a lot of programming and using statistically proven methods of seeing how an algorithm can work. In a lot of the forums I see people advocating strategy that they think works based on intuition, but it is not unless in professional settings that we use actual statistics, hardcore statistics and mathematical model for us to see whether or not something works. And here I want to make that information available to everyone. So we're going to be using a lot of programming in Java and not in platforms. As you will see, platform is very limited. You cannot freely implement mathematical models that you see fit. And as a result, a lot of the optimization and backtesting is not very accurate and it's not a very good predictor of what is going to work in the future. I'm going to try to make the videos very beginner oriented. I don't assume you have a lot of statistical knowledge, but I do assume you have some idea of how to program. I'm not going to be going through for loops or variables or if else statement. You could look that up. I bet you can learn it in a day. I'm going to try to keep the video short because I know how frustrating it is to watch a really long video and not get anywhere. Every time I watch a tutorial video, I watch it in like 1.5x speed. A brief overview of what we're going to be doing. We're going to start by introducing what a Forex market is. Although we're doing currency trading, I believe this works in general stock as well. We're going to be learning how to import files into Java, which is the really boring stuff, but it's necessary for us to continue. We're going to be going through a strategy that I know works, a strategy that I know doesn't work. We're going to be going through backtesting and optimization in Java, which is the cream of the crop of programming in Java and C++, which gives us a way better result than to just try to do it in platforms. Then we're going to try to execute it in a platform, which you will see is really easy. It's going to take maybe one video compared to the 20 others that we're going to be making to actually execute it. Okay, some credit show. I'm a psychology graduate and I took some computer science classes, so I have some idea. I wouldn't say I'm very good at programming, but I have some idea in programming, okay? I know basic statistics. We're not going to be using advanced statistics. So if you don't have any experience in statistics, don't worry. We're going to be explaining every concept along the way as we go, so bear with me, okay? And if I make any mistakes, please correct me in the comment and I will try to fix them. Also, I want to give credit to all my friends at UCLA who helped along this. My algorithmic trading club at UCLA is where I spend a lot of my time in the undergraduate years, and that is where we come up with all this data that took maybe 4 years with like 7 hours a day and 3 days a week to come up with all of these data that I'm going to show you. So thanks to them. So what is algorithmic trading? Algorithmic trading is trading and entering and exiting based on a market specific condition. So when the price is moving in a certain way, we can predict how the price will move next. Rather than following the news, for example, rather than saying Brexit, we predict the GDP will fall. We see that a price is going up and down, so we say that the price is going to go down next. Let's show you an example, shall we? Okay, let's say for example that the price moves like this. Well, the price is never gonna move like that. If the price moves like that, we'll all be millionaires, right? That Lamborghini. Okay, but let's say it does. Okay, so well, what do you think will happen next? Well, obviously it's gonna do this, right? So based on that, we can come up with an algorithm to say that whenever a price moves to this point, we can short it, which is the term for selling, and we can predict that it's going to move down, right? At least this much. And by shorting it, we'll be making this much profit every time the price gets to that point. Now I want to end this video by resolving the conflict that some people say human trading is way better than algorithmic trading or automated trading. But because human trading gives you the experience while you're trading, but what they don't realize is algorithmic trading requires a lot of research too. We are looking at data that's far larger than what you do in human trading. Let's say Joe, for example, is trading in person. He's looking at the stock market right now, and he see maybe 10 instances of a specific strategy happening. Then from the 10 that he succeeded, he will think that the next time it's going to happen again. But with algorithmic trading, we'll be looking at 10,000 instances using the entire Forex history. That would be like, let's say, Mark trading there for 20 years and 24/7. What's 24/7 for 20 years compared to that 10 instances, right? And also based on that, we'll know exactly probability of the next strategy working. Let's say we know it's exactly 80%. Based on that 80%, we can come up with a way to profit. And also, algorithmic trading is very objective. Remember, I'm a psychology major. Human decision has a lot of fallacies, for example. It's kind of like gambling. If you lose a lot of money in the first two trades, you may want to bet even more on the next trade to make the money back. But that may just cause you to lose even more. The computers are not subjected to fallacies that humans make while trading. All the fallacies are weeded out while we are designing an algorithm that works. And also, computers can perform instant execution, which is execution immediately. While Joe wants to trade a stock at a certain price, by the time you see the price, it might have already moved by a little bit. And when will you ever need that kind of accuracy, you might ask? An arbitrage, as you will see. And also, a computer can watch maybe 100 pairs of currency at the same time, while a human maybe can watch 5. And what kind of difference does that make? You'll be losing a lot of opportunity. Let's say you have an algorithm that works 51% of the time. Then you need 100 trades to see that one trade profit. Because all the other trades cancel each other out, all the profit cancel its losses. So you need 100 trades to see your profit. With human, that might take years before you can put that 100 trades in. With computers, you can maybe execute 100 trades in a minute, as an extreme example. So maybe every minute you'll be able to see that profit of that one trade. Okay, so in the next tutorial, we'll be going through what currency trading is. Thank you all for watching. Please subscribe and like, and we'll see you next time.